Hey everyone, my name is Alex Morgan. Imagine two people grabbing the same rope and pulling in exact opposite directions. Neither one is letting go, neither one is backing down. And right in the middle of that rope, stretched, trembling, ready to snap, is silver. That is exactly what is happening in the global silver market right now, in March 2026. And if you own silver, if you are thinking about buying silver, or if you have been watching this metal and wondering, what on earth is going on? This video is going to explain everything. Because the tug-of-war happening right now between Middle East tensions and the US dollar is one of the most important financial stories that most people are not paying close enough attention to. Let us start with the scoreboard, because the numbers alone should stop you in your tracks. As of today, March 3rd, 2026, silver is trading at approximately $94 per ounce in the international spot market. Let that number sink in. 1 year ago, silver was sitting around $32 an ounce. That means this metal has risen nearly 195% in just 12 months. To put that in perspective, most stocks that do 20% in a year get celebrated on the financial news. Silver just did nearly 200%. And yet right now, it cannot seem to decide whether it wants to go higher or crash back down. And the reason is sitting in two very different corners of the globe. One involves missiles and conflict zones, and the other involves a currency that every single human being on this planet is affected by. So let us talk about what is pulling silver up first, because that force is dramatic and it is real. The Middle East. Right now, geopolitical tensions in the region have been escalating in ways that are making institutional investors, hedge funds, and everyday savers deeply nervous. And when people get nervous about the world, when they start asking themselves whether their money is safe, whether their currency holds value, whether governments and central banks can protect them, they run to what are called safe haven assets. Gold is the classic safe haven, but silver follows gold, sometimes even faster and harder. Over the last several weeks, every time new tensions have flared in the Middle East, new military escalations, new threats to key shipping routes, new uncertainty around oil supply chains, silver has spiked. In fact, earlier in this current trading session, silver hit an intraday high of $96.40. That was not random. That was safe haven buying. That was real money flowing into real silver because real people are scared about what is happening on the other side of the world. And here is why that matters so much for silver specifically. When global tensions rise, the demand for physical precious metals explodes. People want something they can hold, something that does not rely on a government promise, something that has been a store of value for literally thousands of years. Silver fits that bill perfectly. It is cheaper than gold, more accessible to regular investors, and it moves faster. So when fear enters the market, silver does not just benefit, it surges. That is one side of the rope. Now here is the other side, the US dollar. And this is where it gets complicated. The US dollar and silver have what you might call a hostile relationship. When the dollar is strong, silver gets more expensive for investors around the world who hold other currencies. A Japanese investor, a German investor, an Indian investor. If the dollar goes up, they have to spend more of their own money to buy the same ounce of silver. That naturally dampens demand. And right now, the dollar has been strengthening. US Treasury yields have been climbing. And that combination, a stronger dollar, higher yields, is the headwind that keeps dragging silver back down every time it tries to break higher. So here is what is actually happening in real time. Silver spikes on Middle East news. Then the dollar strengthens and silver falls back. Then a new geopolitical development rattles markets. Silver spikes again. Then traders lock in profits, the dollar catches a bid, and silver retreats. It is a constant back and forth, and it is happening almost daily right now. That is why you may have noticed silver going from $82 in early February all the way to $96 today, and yet it still cannot seem to hold above that $95 threshold for long. It is not confusion. It is a tug-of-war. And understanding which side of that rope wins will tell you everything about where silver is headed next. But to really understand the stakes here, you have to understand what is happening underneath the surface, because this is not just a story about fear and currencies. This is a story about a metal that the world desperately needs and cannot produce fast enough. The Silver Institute, the most authoritative body tracking silver supply and demand globally, has just confirmed that 2026 will mark the 6th consecutive year of a structural silver deficit. That means for 6 years running, the world is consuming more silver than it mines. The accumulated deficit from 2021 through 2025 alone is estimated at approximately 900 million ounces. 900 million ounces that were supposed to be in storage somewhere and simply are not. And in 2026, That deficit is forecast to widen further to 67 million ounces. Now think about what that means. If you have something the world needs, something that goes into solar panels, into electric vehicles, into semiconductors, into the data centers running artificial intelligence, into medical devices, and you simply do not have enough of it, what happens to the price? It goes up. It has to. That is not a theory. That is basic economics. And this structural deficit is the foundation beneath silver's incredible price rise. The geopolitical tensions and the dollar story are the daily drama playing out on the surface. But the supply crisis is the tectonic shift happening underground. And here is something most people do not realize about silver supply. Approximately 75% of all the silver mined in the world is not mined primarily for silver. It comes out as a byproduct of mining for gold, copper, lead, and zinc. What that means is that you cannot simply build more silver mines to fix the problem. Even if silver prices go to $200 an ounce, most of the silver supply is controlled by companies whose primary business is something else entirely. So higher silver prices do not automatically unlock more supply the way they might for other commodities. The supply is relatively fixed, the demand is rising, and that is the kind of combination that moves markets in a very serious way over time. Speaking of demand, let us talk about where silver is actually going. Because beyond the safe haven buying and the geopolitical fear, there are structural demand shifts happening that are quietly reshaping the entire silver market. Industrial demand now accounts for more than half of all global silver consumption, up 50% since just 2015. The solar panel industry has been a massive driver of this, but here is a nuance most pundits miss. Solar installations continue expanding at roughly 15% per year globally. Yet, manufacturers have been engineering their panels to use less silver per cell. They call it thrifting. So while the solar sector still consumes enormous quantities of silver, forecast at around 194 million ounces this year, that number is actually down 7% year on year, even as the world installs more solar capacity than ever. Efficiency gains are partially offsetting volume growth. But what is filling the gap, and then some, is electric vehicles, artificial intelligence infrastructure, and data centers. The Silver Institute has identified these three sectors as the next generation of structural demand for silver. Every electric vehicle uses roughly twice as much silver as a traditional combustion engine vehicle, and EV adoption globally is accelerating dramatically. By 2027, EVs are projected to surpass traditional vehicles as the single largest automotive source of silver demand. And by 2031, electric vehicles alone could account for nearly 60% of all automotive silver consumption on the planet. That is not a forecast for the distant future. That is about 5 years away. And then there is AI. We talk about artificial intelligence as a software story, as a story about algorithms and chatbots and large language models. But AI runs on physical infrastructure, data centers, server farms, cooling systems, electrical components, all of which require silver. As the global AI build-out accelerates through 2026 and beyond, the demand coming from data center construction alone is becoming a meaningful and growing driver of silver consumption. This is a new demand category that simply did not exist at scale 5 years ago. And it is only going to get larger. So why, with all of this going for it, is silver still stuck in this volatile tug-of-war? Because markets in the short term are not driven by fundamentals. They are driven by sentiment, by momentum, by positioning, and yes, by the forces we talked about at the top, the Middle East and the US dollar. And right now, both of those forces are fighting each other with roughly equal intensity. The result is exactly what you are seeing. Big moves, sharp reversals, and a metal that looks like it wants to go higher but keeps getting yanked back. Here is one more piece of this puzzle that should be on every silver investor radar: China. In January 2026, China implemented a new licensing regime for silver exports. Under the new rules, only companies with minimum production output of 80 tons per year and a $30 million credit line are eligible to export silver. That effectively restricts silver export licenses to just 44 companies in all of China, one of the world's largest silver producers. The downstream effect of this policy is a tightening of the global silver supply chain that the market is still digesting. Less Chinese silver flowing into the international market means less supply available globally. And in a market already running a structural deficit, adding a supply restriction from China is like pouring fuel on a fire that is already burning. So what happens next? Where does silver actually go from here? Here is the honest picture. In the near term, the next few weeks and months, silver is likely to remain volatile and choppy, driven by whatever happens in the Middle East and whatever signals come out of the US Federal Reserve. If tensions escalate further, silver could retest and potentially break through that $96 high. If the dollar continues to strengthen and we see risk-off selling across commodity markets, silver could pull back to the $85 to $88 range before finding support again. That kind of short-term volatility is uncomfortable, but it is noise. The signal, the real signal, is the structural story. 6 consecutive years of supply deficits, 900 million ounces of accumulated shortfall, growing industrial demand from EVs, AI, and data centers, Chinese export restrictions tightening global supply, and investment demand projected to jump 20% this year to a 3-year high of 227 million ounces, as Western investors return to the silver market after years on the sidelines. Against that backdrop, most serious analysts are bullish on silver for the medium to longer term. Equity analysts carry a $120 price target. Some of the most well-known names in commodities believe silver reaches $100 this year. Even the more conservative institutional forecasts from major investment banks are calling for silver to average around $81 for the full year, which, by the way, would still be extraordinary by historical standards. The tug-of-war is real. The dollar and the Middle East are genuinely pulling in opposite directions. But when you zoom out, when you look at the fundamentals, the deficits, the industrial demand revolution, and the supply constraints, only one side of that rope looks like it can sustain its pull indefinitely. And it is not the dollar. Silver is not going anywhere. The question is just how fast it gets there. If you found this analysis useful, smash that like button, subscribe, and drop a comment below. Tell me where you think silver is headed next. Are we going to 120? Or are we in for a painful pullback first? The debate is very much alive, and we will keep tracking the data every step of the way.